Hello and welcome to your trader training. My name is Phil Newton and I am your trading coach. On this training session, we're going to be looking at how to take advantage of the high implied volatility tool that we looked at on the previous training session. As a reminder, on the bottom of the chart here, we can see a visual representation of implied volatility. And what we're doing with it is we're looking back over the last 12 months and we're looking at where the current reading is relative to the 12-month high and the 12-month low. And depending on where it is on that scale, we're going to give it a rank. And what we're interested in is it above or below the halfway mark, the 50% level. Now, in our usual way, we don't need to look at every chart every day, all of the time. We can use this in a tabularized version, which will be here on the left on your primary live account. And then all you can do is click on the column here and it'll sort and rank all your stocks in your watch list, and it'll tell you which of those stocks are high implied volatility or low implied volatility. And again, we're considering anything above 50% on the rank as high implied volatility and anything below 50% as low implied volatility. We can actually use that as a scan in itself. If we know that we're going to be selling options as our primary way of expressing the trade, then we can find stocks that already have high implied volatility and then decide how we might want to trade it by our usual visual inspection of the charts. On this particular occasion, the implied volatility, as you can see, is quite high and it's around the 80% level. So it is to our advantage to be a seller of options. So as a reminder, we've looked at previously buying or predominantly being a buyer of options, and one of the ways that we've done that is to buy single puts and calls or to buy spreads. I'm just drawing a line across where the current stock price is, just for the moment, just so we can visually see what's going on. And again, previously we've looked at buying an option and either a single, and then if we wanted to create a spread, we would typically spread the cost at one standard deviation, is usually how we might go about doing that. And the edge of this tool here, this represents the bell curve that we often use, and the vertical line here is the expiration date. So we would normally create a spread. Again, we would buy an option usually around one strike in the money or one strike out the money, depending on how we're setting it up, as we've previously described, and then spread the costs to make it either more affordable or to remove some of the time decay elements and create this spread. It creates this window of opportunity. And again, we would normally do this, and doing it in this way means that this would still be a debit. So what we're saying is, in this scenario, we would want the implied volatility to be below 50%. Now, we've already established that the implied volatility on this particular stock at this moment is above 50% and it's closer to 80%. So how do we deal with this? Well, what we can do is we can take advantage of the high implied volatility. And as I've drawn this, I've assumed that we might be bullish and will benefit if the stock was to move higher. So let's stick with that same assumption. So previously we might have, again, bought the debits, bought the single call and sold a single call to create the debit spread. Now, if we stick with the same bullish assumption, now that we've got high implied volatility, we don't necessarily need to be right on the stock's direction. We'll get paid quicker if we are, but it's not necessary, because now what we can do is we can sell an option. Now, our starting process now is going to be at the edge of the bell curve. And what I'm going to do in this example, and we'll explain this in more detail later, but what I'm going to do is I'm going to sell an option, but I'm going to start this process at my standard deviation level, which is the edge of that bell curve. So I'm going to sell an option first, and then I'm going to buy one. I'm just going to have to go off the chart slightly. I'm going to buy one that's further away. Now I'm still creating this spread, this window of opportunity, but you'll notice that I'm doing it quite a distance away from the current stop price. So if the current stop price is this line that I'm drawing here, there's usually quite a separation between where I set my trade up. And this is one of the big advantages with high implied volatility and doing credit spreads, as we'll dip into in more detail, is that we get to create this spread, a credit spread, and we do it away from where the current stock price is currently trading. Now remember, with the debit spread, we needed that because we got paid if we were right on direction. Now what we're going to do is create that spread, that same window of opportunity, and with a bullish assumption, we'll get paid if the stock price goes up as usual. But now, if the stock price was to move down slightly, but not go below the credit spread that we've set up, we'll also get paid. So we don't actually have to be right on direction. And similarly, if the stock price goes sideways, we'll also get paid as long as it stays above the spread that we've sold in this bullish illustration. We'll get paid. And this is one of the big benefits of credit spreads and taking advantage of the high implied volatility. Now, why is this high implied volatility important? Because it helps with the valuation of the option. It tells us that, hey, currently the options are priced expensively, and it also adds an extra way that we can get paid. So we'll get paid if the stock price goes up, sideways, or down by a small amount. And the other thing that we know with implied volatility is that it's mean reverting. So if the implied volatility was to normalize, it also gives us another way to get paid, because then the stock price doesn't even need to go anywhere. If the implied volatility contracts, like it did over here, the implied volatility was to contract, then the value of the spread that we've sold reduces in value, which, as the seller, predominantly a seller of the option, is how we get paid. So we get more ways to profit. That's really the point I want to try and get across here. We get more ways to get paid. When we're buying options, we have one way. We've got to be right on direction. Now, when we've got a credit spread, or where we're a net seller of options, we're not necessarily saying that we want the stock to go up in a bullish example. What we're really saying is the exact opposite. And the exact opposite is we're saying that we don't want the stock to go down by any large amounts. It can go down by a small amount, as we've just highlighted. We'll still get paid. It can go sideways, we'll get paid. Implied volatility contracts, we'll get paid. If it goes up, we'll get paid even faster. So we've got more ways to get paid. There's around 5 different ways that we can get paid when we're selling, or a net seller of options, because a combination of things can happen and we can get paid significantly faster. Now, there is a trade-off with this, which we'll cover later on, but this is the kind of the nuts and bolts, the 10,000 foot view of credit spreads and taking advantage of the high implied volatility. Because they're more expensively priced, we can take advantage of that to add an extra way to get paid, and it means that it opens the door for lots of other ways to get paid as well. When the implied volatility is low, they're inexpensively priced, and it might be better to be a buyer of options. Again, we've covered this before, but again, just putting them next to each other, this is the difference between a debit spread or being a net buyer of options. We've got to be right on direction. And a net seller of options, we don't. It takes that directional risk away. We don't have to be right on direction, and we'll still get paid, which is a great advantage. More ways to get paid. Primary reason, or one of the primary reasons for it, is that we're not selling our options around where the current stock price is. We can do it some distance away from where the current stock price is if we're smart about our setup, which is what we're going to explore on the next couple of training sessions. So that's where we're at. This is the 10,000 foot view of credit spreads and using them with high implied volatility.